Hello everyone, it's me Vimar Farooq. Welcome to Life Money. Today we are going to understand intraday trading part 1. So let's start. Imagine you are walking into a cricket stadium. You have never held a bat before, but you tell Virat Kohli, move aside, I am going to score a century today. What do you think will happen? Exactly, you will probably get out on the very first ball. The stock market is no different. Every day, thousands of beginners open a trading app, deposit money, watch 2 YouTube shorts, and suddenly believe they are professional traders. Then reality arrives. Within a few trades, their capital disappears and they start saying the stock market is gambling. No, the stock market isn't gambling. Trading without knowledge is gambling. Today I am going to teach you the right foundation of intraday trading. This lesson isn't about becoming rich tomorrow, it's about learning how professional traders think before they place even a single trade. By the end of this section, you will understand trading accounts, Demat accounts, leverage, stop loss, technical analysis, risk management, and why protecting your money is more important than making money. So grab a notebook because today's lesson could save you thousands of dollars in future mistakes. Let's begin. What is intraday trading? Let's start with the most basic question. What exactly is intraday trading? The word intraday simply means within the same day. Suppose you buy a stock at 10 a.m. If you sell it before the market closes on the same day, that's intraday trading. You don't keep the stock overnight. You buy and sell within one trading session. Think of it like buying vegetables in the morning market and selling them later the same day when prices rises. You are trying to profit from short-term price movements rather than long-term investing. Now here's where many beginners make a mistake. They think intraday trading means easy money. That's completely wrong. Professional traders spend years learning charts, psychology, and risk management before they become consistently profitable. Success in trading isn't about predicting the future, it's about managing uncertainty. Chapter 2, Trading Account vs. Demat Account. One of the first confusing topic for beginners is understanding the difference between a trading account and a Demat account. Let's simplify it. Imagine you are shopping online. Your shopping cart is where you place your order. Your home is where the product is stored after the delivery. A trading account is like your shopping cart. It helps you buy and sell stock. A Demat account is like your home. It stores your shares electronically. Without a trading account, you can place, buy or sell any orders. Without a Demat account, you can't hold shares for delivery. In intraday trading, since positions are closed on the same day, the shares usually don't remain on your Demat account overnight. Many beginners think both accounts are the same. They are connected but each has different purpose. Understanding this basic concept prevent confusion later when you start using a broker trading platform. Chapter 3, What is leverage? Now let's talk about one of the most exciting and dangerous feature in trading, leverage. Imagine you have only $100. Your broker says, don't worry, I will let you trade as if you have $500. Sounds amazing, right? Well, yes and no. Leverage increases from buying power. That means you can control larger positions within a smaller amount of your own money. Here's the problem. If your trade goes in your favor, your profit becomes larger. But if the trade goes against you, your losses also become larger. Leverage is like driving a sports car. A sports car can take you to your destination much faster, but if you lose control, the accident is also much bigger. Professional traders don't use leverage because they are greedy. They use it only when they have well-tested strategies and strict risk management. Beginners often think more leverage means more profit. No, more leverage simply means more speed. Whether that speed takes you to profits or losses depends entirely on your discipline. Chapter 4, Target and Stop Loss. Now imagine you are driving from one city to another. Before you start, you already know where you are going. You also know what you will do if the road is blocked. Trading works exactly the same way. Before entering a trade, you should know two things. Where will you take your profit and where will you accept your loss? The profit level is called your target, the loss limit is called the stop loss. Without a stop loss, one bad trade can destroy weeks or even months of hard work. Many beginners refuse to close losing trades because they hope the market will come back. Hope is not a trading strategy. Professional traders accept small losses quickly because they know protecting capitals is the first priority. Remember this sentence: a small loss are business expenses, big losses are business killers. Chapter 5: Technical Analysis, Learning the Language of Charts. Now that we know how trading works, let's answer biggest question. How do traders decide when to buy or sell? The answer is technical analysis. Think of technical analysis like being a weather forecaster. A weather forecaster doesn't guarantee rain tomorrow. Instead, it studies past weather patterns to estimate what is most likely to happen. Similarly, the technical analysis study price movements, charts, patterns, and trading volume to estimate future price direction. Notice one important word: estimate. No indicator, no chart can predict the most 100% accurate trade. The market doesn't reward certainty, it rewards discipline. One of the biggest mistakes beginners make is looking at 10 different indicators at once. Imagine asking 10 different friends where to eat dinner. One says pizza, another says burgers, one wants biryani, someone suggests sushi. After 15 minutes, you are still hungry. That's exactly what happens when traders overload their charts with indicators instead master a few tools really well. Professional traders often keep their charts simply because simple decisions are easier to follow. The three core beliefs of technical analysis. There are three important ideas every trader should understand. First, the market discounts everything. This means news, earnings, emotions, fear, and greed are always reflected in price. Instead of reacting to headlines, traders observe price behavior. Second, price move in trends. An object rolling downhill usually continues downhill unless something stops it. Market behaves similarly. An uptrend tends to continue until sellers become stronger. A downtrend tends to continue till buyers regain control. Your job is not to ride the trend, your job is to identify it. Third, history often repeats itself. Human emotions don't change. Fear and greed existed 50 years and they exist today because human behaviors repeats. Certain charts patterns also repeat. That's why traders study historical charts. Chapter 6: Understanding Indicators. Let's now talk about indicators. Indicators are mathematical tools that help traders interrupt price action. Think of indicators like a car dashboard. Your speedometer tells you how fast you are driving. Your fuel gauge tells you how much fuel is left. Neither one drives the car for you. Indicators don't place trades. They simply provide additional information. Some popular indicators includes moving averages, RSI, MACD, and volume, but here is the secret many beginners don't know. Professional traders don't blindly follow indicators. They use indicators to confirm what the price is already saying. The price is always comes first. Indicators come second. If price and indicators disagree, many experienced traders trust price more than the indicator. Don't chase quick money. Build lasting knowledge because money earned through knowledge stays longer than money earned through luck. This is the end of Intraday Trading Part 1 video. Thank you for watching. Stay tuned for next video on Saturday 6:30 p.m. Bye.